Welcome. This video gives you a brief overview of the bank trader strategy. Hello, this is Dean Malone with Compass FX. A few years ago, I had the good fortune to have dinner with a bank trader. He had worked for a number of major banks during his 25-year career. And over dinner, we discussed bank trading operations and institutional trading. And much of what he said sounded pretty familiar. Then our discussion took an interesting turn. He began talking about his proprietary trading for the banks. And one comment he made really startled me. He said, "I already know the levels I'm trading tomorrow based on what the market has done today." Well, this really got me intrigued. And I started to listen in a little bit more about what he talked about. And he mentioned that global banks and financial institutions use similar market data points to determine future market movement. And from this data, they plan and execute trades. Before I talk more about the bank trader strategy, I think it's only fair you know who I am and why I developed the bank trader strategy. I'm a registered broker, a member of the National Futures Association, and a commodity trading advisor. I've been interviewed by CNBC, Reuters, CNN, Wall Street Journal, and others. And I've trained tens of thousands how to trade the Forex market since 2002. I mention my background to let you know what I've experienced in the institutional trading world. And I want you to have similar tools the institutional traders use. Even more, I want you to experience a greater simplicity in trading, and that's why I created the bank trader strategy. With the bank trader strategy, you have the ability to view the market from a bank trader's perspective and identify levels to trade at the open of every day. As a licensed broker, it's important to me that you are aware of the disclaimers in trading the Forex market. And be aware that Forex market is not suitable for all traders and your trading results may vary. No representation is being made that any software or training will guarantee profits or not result in losses from trading. So what is the bank trader strategy? It's a trading model that identifies daily and weekly trade levels that major banks and institutional algorithms use to determine entry, target, and exit levels at the open of the day. So the question you might be asking is, why should I use it? Well, the market tends to move within previous daily and weekly levels, and this gives us as traders an advantage. As a matter of fact, it gives us 3 advantages. With the bank trader strategy, we can identify daily and weekly trade levels at the open of the day, we can identify trade zones and target levels, and we can recognize directional market patterns. So what do other traders who are trading with the bank trader strategy have to say? Well, George writes, "The bank trader strategy for me has been one of the best additions from Compass FX. It offers a clean chart with entry and exits for many different situations and covers multiple strategies under changing market conditions." Gene writes, "Quick note to give you my sincere thanks for sharing the bank trader strategy. It is an awesome trading system and has been extremely successful for me." And Kevin writes, "After learning the bank trader strategy, I can say that in my first year of trading, it has been a game changer for me." And another trader, Dave, writes, "I found the concept of the bank trader strategy very logical. The results are pretty impressive and the charts are very clean." So now that you've heard a little bit about what other traders are saying, let's talk a little bit more detail about the bank trader strategy. First, let's look at the structure of it. What does it look like on your chart? Well, the bank trader strategy calculates the daily levels, weekly levels, and daily trade zones at the open of the day, and these levels are automatically displayed on your MetaTrader 4 chart. Now, the daily levels, we have a daily midpoint, yesterday's high, yesterday's low, the open of the day, what we refer to as an inside range, and then there's the range for the day. And we also have high targets and low targets. These are all laid onto the chart, and you have labels for each level shown. The weekly levels are much like the daily levels. We have the open of the week, we have the previous week's high, the previous week's low, weekly high targets, and weekly low targets. Again, each one of the levels has a label to the level if you want to see the label. Now let's get a little bit closer in to actually trading with it. There are certain zones that we've identified in the bank trader strategy: a buy zone, neutral zone, and sell zone. Let's take a look at each one of these zones a little bit more in detail. When price is in the buy zone, traders look for long trade entry conditions. When price is in the neutral zone, this is where traders expect choppy price action and the market to be range bound. Often we find price in this level when there's uncertainty in the market. Sometimes this happens right before a news announcement. And then we have the sell zone. When price is in the sell zone, traders are looking for short trade entry conditions. What about trading with the bank trader strategy? Well, there are two determining factors to trade the bank trader strategy: technical market bias and trade style. And what I'm getting at here is you can take what is shown to you by the daily levels, weekly levels, and target levels, and then trade it based upon your style of trading. When we talk about technical market bias, we're looking at the analytical market bias. Now, market bias is the general consensus of investors and traders of the expected or intended direction of the market. And knowing the market bias at the open of the day can give a trader a head start advantage. What we're looking for here is an edge, is the way that you can look at the market and determine most likely what the market will do before the market does it. That is an edge. With market bias, there are 5 different scenarios: long bias, short bias, an uncertain bias, long reversal bias, and short reversal bias. The long bias, the expectation is that price is going to rise higher above the open of the day. The short bias is the expectation that price is going to drop lower from the open of the day. When we get uncertain bias, this is where there's no clear direction. The market is range bound and may be waiting on an economic event or a news announcement. But this is a clear indication to let go of the mouse, step away from the keyboard, or go find another currency pair to trade. Then we have the long reversal bias. Now, the expectation here is the fact of a reversal from a previous downtrend, whether that is a retracement in the market or a true reversal. Whereas the short reversal bias is we've been in an uptrend and now price is reversing and going short, opposite of the previous uptrend. So we expect continuation in the short direction. Now what we do is we take the technical market bias and then we match that to your trade style. There are different traders out there, from scalpers to active traders to more swing traders and even position traders. Let's take a look at each one. From an active trade style, we're trading a 1-minute to 15-minute charts. We're looking to enter at a level trading away from the open of the day in the direction of technical market bias. Then we're looking to exit a trade at a high target or low target level. Now here's an example of an active trade. We see at the letter A that the market has moved along the open of the day, the white line, and has dropped a bit on top of the buy zone and now taking a bounce. We can enter a long trade on the bounce off the buy zone. And then price reaches up to yesterday's high and tests the open of the day. At C, we see price moving up to high target number 1, where we could potentially exit our trade. Now, a second trade occurs here when we get a very strong move back. The market drops from the high target number 1 all the way back down to the daily midpoint, the DM, noted in the chart. And then we get a bounce off the daily midpoint, giving us another potential long entry, and we trade that back up to yesterday's high. As it tests the open of the day, we're looking for continuation. Price continues pushing up higher, and at your election, you can get out at target number 1, 2, or target number 3. In a swing trade, what we're looking for is continuation or reversal of the previous day's trend through the trading sessions of the current day. And this trade style can be monitored from a 15-minute chart to a 1-hour chart, and it may take a few hours to complete. Here's an example of a swing trade in a trend continuation. You can see that the market had started the previous day in a downtrend. And then the market hits from the open of the day, it pushes up, and at the letter A, we have a test of the sell zone. And the market puts in a swing high. The market drops back over and retests the open of the day at B, putting in a lower high. as the market crosses the open of the day, we have a potential entry short as we drop below the open of the day in continuation of the downtrend from the previous day. So we can enter the trade near the break of the open of the day short and look to exit our trade down at the low target number 1 or the low target number 2. This is an example of a swing trade trend reversal. As you can see, the market made a very strong move up the previous day, and we open up the day near the high of the previous day. The market drifts back down, tests the buy zone, and then bounces back up to test the open of the day. When the market cannot maintain the open of the day and falls back over from B down to C, we have the opportunity at that moment to enter a short trade as the market continues to drop down and cross over the daily midpoint, and look to exit our trade at the bottom of the sell zone or at a lower target. Now, for those of you who may be position traders looking to sit into a trade over maybe a day or two or longer, this might be just the fit for you because we're looking at the weekly levels. Position trades can be achieved by targeting weekly levels from the open of the week or a break of the previous week's high or previous week's low. It's recommended to use a 1 hour to daily charts to monitor and trade the weekly levels. And like I said, trades may take 1 to 4 days to complete. Now here's an example of a position trade in a trend continuation. If you look to the left of the chart, you notice that we're in an uptrend and the market proceeds up to the open of the week. As it's sitting at the open of the week, it kind of retraces a bit to the open of the week and then it starts working up to the previous week's high. So we look to go long as the market pushes higher from the open of the week. Then as the market moves up to the previous week's high as a potential target, if the market holds the previous week's high and continues to push a bit higher, then we target the weekly high target number 1 or the weekly high target number 2. And you can see in this example, the market pushed all the way up to the weekly high target number 2. Now this is an example of a trend retracement position trade. We can see from the previous week that we pushed up to a high and the market the following week opens up near the high of last week. And then we get this immediate retracement off. When the market started falling from the open of the week, there's a slight test at the open of the week. Looks like it took a few hours near the open of the week, but eventually it drops down, makes a lower low, gives us an entry short, and then we look to trade that short down to the previous week's low, and then on down to lower weekly targets. And finally, we have the weekly breakout. This is a great trade for position traders because we're looking at the break of the previous week's high or the previous week's low. And generally speaking, when you have a break of the previous week's high or low, you have good, strong momentum that's going to carry the trade onto a target level. In this example, we can see that the market had basically traded range bound the week before. And at the open of this week, we can see the market pushed up off the orange dash line showing the open of the week up to the dark green dash line representing the previous week's high. Can't seem to break the high, and it falls back over. Now there is trading opportunity inside the week from an active trade point, but as a position trader, you're looking for a break of the previous week's high or the previous week's low. And what does the market do? It retraces all the way back down the previous week's low, tests the low, and then breaks the low. At that point, you step into the trade short and you look to trade it down to the weekly low target number 1 or the weekly low target number 2. Last but not least, you should know that the bank trader strategy comes with alerts, built-in alerts to help you identify opportunities available to you in the market. Now, the bank trader strategy has a breakout alert option. When price is at a level or within a number of pips from a level, the breakout alert will trigger. Now, what are those levels? Well, we have yesterday's high and yesterday's low. So we're looking for a potential breakout of either one of those levels. Also, we have the inside range high and inside range low. Especially if you're an active trader, this is a great tool to use because when we break the inside range high, we're looking for a push up to yesterday's high. If we get a break of yesterday's high, then we're looking for a push higher to one of our daily high targets. So these come in really handy and make you aware, if you're monitoring multiple charts, it makes you aware that there's a potential trade condition on one specific chart, and you can go and monitor that chart. Now, all of these can be ran at the same time. The way it's been developed is that there will be a pop-up message alert box with all 4 types of breakout alerts can be shown. As you can see in this example, we can see that we have the inside range low breakout sell entry. We have yesterday's low breakout sell entry. We have yesterday's high breakout buy entry. And we have inside range high breakout buy entry. So you can see in this example that you have the alert applied to multiple charts, and the alerts will appear in order as they are triggered. I want to thank you for taking your time watching this brief overview of the bank trader strategy. But I got to ask you a question. If you knew at the open of the day where major banks and large financial institutions were looking to step into the market, would that make a difference in your trading? Also, if you knew where they may be trading to as far as potential targets, would that make an impact in your trading? Most likely it will. So I encourage you to add the bank trader strategy to your tools in trading. This is Dean Malone with Compass FX, wishing you a great day and good trades.